Welcome everybody. My name is Phil Brown. I'm one of the partners and the commercial manager at Xact Accounting. I'm joined by my colleague, Dan Wilkinson, who is the real brains behind this webinar today. And I'll be handing over to him in a minute. I just thought to begin with, though, that I would just share my screen so that we can kick off and get moving with this webinar. Just do the tech thing. You can see that all right, Dan?
Yeah, it's popped up well. Yeah, good to go.
Okay. So just quickly, a bit about us. We are building and construction specialist accountants. So that's, the vast majority of the work we do. We have a few other bits and pieces, but, I would think something like 90% of our work is building construction. We do a whole suite of different services, starting with bookkeeping, helping businesses get that part of their world in good shape. Something that a lot of our clients, spend a lot of time on. We prefer to take that time off them so they can get involved with higher leverage activity in their business. And it's a real critical input in terms of getting accurate numbers in your world as well. So we've just kicking off our bookkeeping division, so more coming on that soon. Tax and compliance. So we have a dedicated tax and compliance team. So all things tax and structuring, how you want to set your business up for success from a tax and structuring perspective. And then the focus for today is more of our CFO Advisory team, which is what Dan heads up for us. In basic terms, there are two types of accountants in this world, as far as I know it. There are tax accountants who just love tax, and we've got a bunch of them. And then there are commercial accountants, who is more what Dan and his team are about. And they can't stand tax. They have to know about it, but really they're all about margins and improving the business. Making sure that at the end of the day, all that hard work is going to profit. And so that's what their focus is on. And so we offer that service to businesses who ordinarily won't be able to afford a full-time CFO in their business, but they really do need those kind of insights to help them grow. So the agenda for today, why budget? So Dan's going to take us through the business case for having a good budget. He's then going to go through the actual budgeting tool that we've built that we'll be sharing after this webinar. We'll also be sharing the video from this webinar as well. So don't worry about, if you miss anything or you've got to check out, we'll be sending this hopefully tomorrow so that you can watch it through again alongside the tool and really learn how to master budgeting. And then there'll be a Q&A at the end. The Q&A, or actually just at the end of the budgeting walkthrough, so Dan will walk through the tool, and then we'll sort of work through a few different scenarios as well in terms of, what if, you didn't have a whole lot of jobs coming up in the second half of the year? What does that impact? How does that impact the budget? Some scenarios like that we'll talk through as well. And then at the end, we'll go through a Q&A section. I just thought it'd be useful to show how budgeting fits into the ecosystem for us and our CFO Advisory services. So you see we've got three sort of layers in terms of the way our service works. There's a reporting layer, so the actual output of your numbers and what we can learn from to build the insights to help improve your business. There's the platform layer. So this is all about the kind of platforms that you're operating in your business. And then process layer. So, how do you use your platforms? How do you work with your team? How do you apply good practice in your business when it comes to processes in this world? So today you can see we're touching on quite a few of these items from the stack, which I guess points at how critical budgeting is to the whole picture. So budgeting and P&L from a reporting perspective, our accounting platform and bookkeeping platform, so the sort of platforms you've got in place there, and then across all of these processes. It really does touch so much in your business. Today's presenter, as I said, is Dan Wilkinson. He is one of the partners here at Xact. He's also the head of our CFO Advisory team. He is not a tax accountant. He's a commercial guy. He's held down roles across a range of different industries, from financial accounting perspective up to sort of CFO, management accounting up to CFO level for private but also listed companies. These days, and for a while now, he's dedicated most of his brainpower to the building industry and helping businesses, usually in that sort of 5 million to 30 million turnover, make a lot more sense out of what they're doing each day, build more financial visibility into their world, and hopefully improve the profit outcome for them. Take a bit of pressure out of everyday life as well, because obviously stuff's pretty stressful. So that's Dan. And Dan, without further ado, mate, I'm going to stop sharing so that you can take over from here.
Yeah, thanks, Phil, and appreciate the short synopsis, mate. Can you see that on my screen okay? Is that presenting okay before we jump into the detail?
I think so. Just try again for me, Dan.
Yeah, sorry.
Yep, I've got that. Yep,
let's
go again.
Let's go one more time. All right. 3, 2, 1, action.
Yep, we're good to go.
All right. Yeah, look, guys, thanks for jumping in and carving out a bit of time for this. I mean, a fair few of you might have had a crack at budgets, whether it's for your business or personally, but especially if you're trying to sort of change gears into that big business thinking, and if you're sort of cracking a $2.5 million turnover, stuff's getting messier. There's more people, more cash flying around than ever before. I mean, the budgeting piece is so important for your business, and it's just standard big business thinking. I mean, I've done a couple of big roles at ASX listed businesses, and every single one has a budget, and is sort of driven in and disciplined, and you measure yourself against it as well. So look, I mean, again, thanks for coming out a bit of time to come onto this one, but let me jump straight in. So usually in my role here, I guess at Xact Accounting and CFO Advisory, a fair few builders come in, and look, they sort of range, some of them are really close. They see that last 5% to sort of crack that financial clarity bubble. Others sort of need a bit more help, but this is a typical builder that I see, or, I guess a typical potential client that comes in. And the big thing I see is, first and foremost, is a lot of businesses managing their business by their bank account. And what I mean by that is, revenue is incredibly lumpy for builders. 1 month you might have bucket loads of claims, the next month quiet. The sprint to Christmas, you punch out all your claims in December, January is really quiet, February ramps up, etc. And you go, well, there's cash in the bank account, that must be good, or there's very little. What's going on? And you sort of ride that emotional roller coaster, which has a pretty serious ups and downs, especially you get a lot of claims in, a lot of claims out. But what the business should be doing is I guess, managing its business by its gross profit. I mean, overheads are easy to squeeze, and I'll get to this a little bit later, but if you're managing your GP, you have that under the microscope, you're micro measuring it everywhere. Cash as a byproduct always works out, minus catastrophic events like, people falling over or anything like that. But if you're only managing your business by your bank account, you're in some pretty serious danger territory there. The other thing as well is people love mapping out, I guess cash. So they grab the back of the beer coaster, go, this claim's coming in, that claim's coming out. My bookkeeper's told me I got 100K in creditors to pay. As long as my cash is positive, it must be all right. The really important philosophy with budgeting is we do, I guess, like an accrual method. So in my world, for example, when you raise an invoice, to a client, here's a $150,000 stage claim. That's when we recognize the income. And it's the same for the tax side as well. But the invoice gets raised, and, the cash might be received next business day, 7 days, 30 days. But it's basically as soon as the invoice is raised, or say you enter an invoice from a creditor into your system, regardless of the cash payment, that's when you recognize the profit, or I guess the debit credit entry or the revenue cost side, however you want to sort of slice this. So just be really careful when you are doing your budgeting that you really differentiate between cash and accrual accounting. So, I mean, accrual isn't meant to be a jazzy word. It's the philosophy that we'll run through with this budget. The other one as well is I see the back of the beer coaster MBA, which is, I guess, DIY accounting. So usually when I sort of sit down with clients, I do a thing called a deep dive, like how the business, how are you going? Can you pay your bills on time? They're like, oh, cash is okay. You know, I've got this money coming in, that money coming out, and they grab the back of the coaster and scribble it down. You can't run your business like that if you're getting bigger and bigger. And, you know, not trying to generate fear or anything like that, but it's easy to pile on contracts and revenue at this stage, you know, revenue and contracts and all the rest of it. You know, build a house, you know, 18 months ago, you know, compared to now, you know, I guess costs are going up by 30, 40%. It's easy to pile that revenue on. And then obviously with more revenue, more cash, more risk. And you go, well, how do I sort of manage that? Well, budgeting is sort of step one, square one, as far as trying to craft out a plan into the future. So the back of the beer goes to MBA, have to avoid that as well. So why budget? I mean, I speak to a fair few builders, especially if you haven't done like a rock star level budget before. I mean, you can sort of sit in a dark room, bust out a spreadsheet, punch it out, and then never look at it again for 12 months or 18 months, or coming into tax time and going, oh no, I better dust this off. But it's really important looking into the future too. I mean, one, obviously you're in business to try and generate wealth for you and your family. So if you go, hey, here's my budget, here's how many contracts I can have on one stage, map them all out. Here are my overheads. What are they running out? Does it make sense? And I'll get into the ratios a little bit later, but you really want to map that out and go, look, if I sort of head down, bum up and push out for 12 months, then go, well, look, here are where my current contracts finish up. You know, they could wrap up sort of like, I don't know, December, November. Here's a couple in the pipeline. I've got this big hole in Q4 where my overheads still hanging around, but I've got no contracts. So you can actually reverse engineer a sales budget out of that as well. You know, hey, client XYZ, you know, you need to go hunting for $600,000 worth of contracts come 1 April. And it sort of just builds out a bit of a pipeline. And I guess creates a bit of urgency in the back of your mind too, that if you have got holes there, what you need to chase and what you need to hunt down. So it's super important. The really big thing I see missing a lot of the time is whether you do a good budget, average budget, or, you know, great budget, is you build the budget, but then you don't measure yourself against it. And that's super important. So what big ASX businesses do, and, you know, all of our clients, we sort of get together, build out this budget, has heaps of science, heaps of evidence, and go, right, well, come 1 July to the 31st of July, go, what was our budget? Pull in all of our accrual accounting, measure yourself against it. Are you on track? If not, why not? What happened? And ultimately, I guess it is a bit of an early warning system as well, because if you get to like August, September, and you're hoping to make 30 or 40 grand a month, you know, whatever your budget says, you're only coming at 20 or 10, at least it sort of gives you I guess an early warning system. You see the bus coming, you go, well, how do I sort of plan and adapt and try and get ahead of this? You know, have I got a margin problem? Have I got an overhead problem? Because I had this beautifully crafted out plan. Why am I deviating? Why am I missing? And it's really important. And ultimately too, I mean, it's a roadmap and scorecard for your business as well. You have your plan, have your targets, you know, how many contracts you have to win, how many laborers you have on hand as well, chippies, whatever it happens to be. It's a plan. If you're sort of floating day to day, week to week, and just constantly playing defensively and putting out fires, all the rest of it's not very fun. You know, that, I guess that forward-looking piece takes you from owning a job to owning a business. And if you're owning a business, you have a budget. So I will jump into the budgeting spreadsheet now, but hopefully that was just a really quick synopsis as to why budgeting is important and what it is. Now, what we're looking at here, and I'll push through this at a pretty reasonable pace, but this tool will be available at the end of the webinar. It'll go to those that have registered as well. This here is full of dummy data too. So obviously there'll be a bit of a clean spreadsheet that comes out of this.
I don't think we can see your spreadsheet, mate.
Okay, yep, sorry. Thank you, Phil.
No worries, mate.
Try again. Lucky you're here, mate. I was charged on. People.
Oh no, that would have been a good recording at the end.
Yeah. Terrible. No, thank you, mate.
All right, you're away and running. See ya.
Yeah, thanks, Phil. Apologies, guys. So what we're looking at here is the template that'll be available to everyone. And look, this is really close to the template that I use here personally in CFO Advisory as well. And I mean, look, the template's one side of this coin, but it's almost like personal training. I mean, the more time and effort and energy you put into it, you know, the more you'll get out of it, and the more, I guess, you'll lean up quicker. You'll be across your numbers better. I mean, budget is the same too. I mean, if you jump into this and go, well, look, income is going to be 200 grand a month, and you flatline that, this whole process loses value pretty quickly before you even get to the meat and bones of it down below. So it's really important to sort of put a heap of energy and effort into this, and I'll get into that in the later profiles down the bottom. So what we're looking at here is a profit and loss budget. So this isn't a cash flow or balance sheet or any of those. This is a P&L budget. And again, the whole philosophy behind this is to look out into the future, map out your current jobs, drop in stuff that you have in the pipeline as well, put a lot of science behind this, drop in your margins, map out your overheads as well, and go, right, does this business model work? You know, am I hitting a 10% return at the bottom, which if you're a builder here and you're sort of sitting inside that 80% on that bell curve, you know, you're sort of ignoring super large commercial businesses, I mean, you should be making a 10% return at the bottom. So if you hammer this together and it's not seeing a 10% profit number, so basically for every dollar that comes in, you keep 10 cents at the bottom. That's what profit percent means. If you're not hitting 10%, and again, there'll be ups and downs, but if you're not hitting 10% overall, you need to recut this pretty quickly. And it's either overheads or jamming in more sales or improving your margin. So without further ado, so we have a builder here called Century Builders. They've had a chat to their better half, bookkeeper, CFO advisor, whoever it happens to be, and they've gone, right, well, this is our budget for the year ahead. And what we're looking at across the top here is these are the months. We just grabbed FY24 because it's forward looking and it's a really timely part of the year. And then over on the left-hand side, I usually find builders are well across the P&L, but we have income here. We have cost of goods or COGS or direct costs. You know, there's a lot of names for them. One minus the other is your gross margin. And this is where you'll move the needle by focusing on this tremendously. I usually sort of say, you know, if you are building a budget, I'd probably go for every hour you spend in overheads, you need to spend at least 4 or 5 hours up in this area here. Because overheads are easy to manage, yeah? I mean, you have the same phone plan, the same fuel, same tolls. That's not where you're going to make money. Where you're going to make money is stretching and grinding this pretty hard. And obviously, those beautiful quotes that you build out that have lines and lines and lines, measuring yourself against that. So the same philosophy can be applied for a business-wide budget as it is for job costing, exactly the same philosophy. This is just business-wide and going, well, if we grind out the next 12 months, how much money are we going to make? And here's our well-crafted plan. Are we doing enough to ensure that we hit it? And then you measure yourself against this month to month. That's big business thinking. So pushing on further down, there's like a little miscellaneous line for like other income here. And you can click on these pluses here to drop out other lines, but you might have like apprentice rebates or stuff in the background that you might want to drop in. I mean, obviously every dollar helps, but this is the plan in the background. Coming on down to overheads, to be honest, guys, like if you have more than sort of 25 lines in your P&L or, you know, 30 max in your, I guess in your ledger, you run a P&L and it goes on forever and ever and ever. You got too much noise, to be honest. Best to sort of keep it between, you know, 20 to 30 lines. Anything more than that, you're wasting your time or you're burning time going, where does that fit? You know, where's that $50 invoice fit or that $200, you know, tool replacement fit? If it's anything more than that, you probably want to trim it pretty quickly. So these are the overheads here. You can generally map these out pretty easily, but again, I wouldn't spend a tremendous amount of time here. For every hour you spend here or half hour, whatever the metric is, I'll probably spend 4 or 5 up here, if not more, making sure these numbers work. And then coming down to the bottom here are the total overheads. And then this here's a really important number for builders as well. And again, this will probably apply to 80% of you on, I guess, on the call, whether you're, I guess, a Sparky commercial builder, whatever it happens to be. This magic ratio here, because it doesn't matter whether you make 100,000 or, you know, 5 million in revenue at the top. If you go total overheads divided by total revenue, it spits out this ratio here. And as long as you as a builder are running at 10% or better, so basically it means for every dollar you generate, you're spending 10 cents on overheads, you're doing pretty well. Rockstar level is 8 cents. So for every dollar you get in, you're spending 8 cents on overheads. GPs run between, say, 20 and 25%, up to about 30% of those some reno builders getting at the moment. GP, so not markup, GP. Be really careful about that as well. Again, and it is a game of ratios too. So if you're spending 25, or sorry, say you're getting $1 in and you keep 25 cents in GP and you're spending 10 cents on overheads and you make, well, then you make 15 cents down the bottom. So it's and again, if you can keep that really steady, you get that GP higher, more and more, it drops out to the bottom line for you guys as well. And keep in mind, that should be after you pay yourselves too. So commonly builders, I guess, either swinging the hammer, doing the sales, whatever it happens to be, you should be paying yourself a wage, either in overheads or up in cost of goods. So this here is your earnings as a shareholder. So it shouldn't be wages plus this, you know, this should just be the bottom line after you pay yourself a fair wage. So that's the P&L at a high level. So total overheads, there's some minor interest and depreciation here. And then obviously revenue minus all costs spits out this number down the bottom, which is your profit. and you do expect it to bounce around depending on timing of claims as well. So a really important thing just to mention now is that this doesn't include calculation of WIP or trying to push that out. It's more around timing of claims and assuming you have 3, 4, 5, 6 jobs on, plus a lot of this should normalize out. But if you're trying to budget WIP, that'll be a nightmare. Like even I don't do that for some of our larger clients, but we do it for the actuals as well. So how does all this come together? Well, we'll probably start with the most important section first, which is this. So cost of goods, this section here is really just a function of revenue in the background. So keep in mind, just a really quick one-on-one with cost of goods. That's anyone that is swinging the hammer, materials, sub-trade, suppliers, any of those people should be sitting up in here. If you have tradies, chippies sitting down here in overheads, you need to move them pretty quickly, otherwise it's going to throw all of this out. And it's a pretty sort of simple adjustment to make in 0 MYOB. I mean, you can do that pretty quickly. You just do a bit of Googling. But first step is making sure that obviously your COGS are in the right area too, and obviously that you're estimating in the correct fashion as well. So we'll spend a bit of time on income. This here is really a function of revenue, and I'll talk about that shortly, but we'll come into the revenue side first. So we have 2 lines here, and it's really important to sort of differentiate these. One is, what is your existing job? So if you're coming into 1 July from the 30th of June, you might have $1 million job. You've already built out 500. Well, you've only got $500,000 plus provisional sums and other stuff in there that you have to drop in. So we have to go, well, what has been built to the 30th of June? And then obviously what invoice are you pushing out from there onwards? That's existing jobs. And that should be pretty easy to map out. If you have 10 stages of claims and you've got 5 left and you turn around to me and go, Dan, I don't know when I'm going to send these out. We've got bigger problems than budgeting on the go. I mean, you'll know roughly how long the project has to go for, the major milestones, the hurdles that you're running towards. You obviously have to do the work to get the claim out. If you say, oh, look, I'm a little bit unsure, yeah, we have to have a bit of a different chat or change a bit of a different gear, but definitely have a punt at it. And again, the more people probably involved in this process too, if you have a construction manager, project manager, whatever it happens to be, if you have those people around, it's always good to get those people involved too, and it'll sort of help drive a bit of ownership into this process. So this section here, revenue profiles, we have sort of split it into 2 categories. And this first section here is existing projects. And then the section down the bottom here is new projects, the stuff that you have in the pipe, stuff that's signed, that hasn't quite kicked off yet. And then down the bottom is just like miscellaneous income. I'd probably spend 10 minutes max on this. And what you can do here is you might have apprentice rebates, interest income, other miscellaneous income, just right over the top and go, well, look, I think it's going to drop, X amount here, whatever it happens to be. And this is all dynamic and it updates to the front as well. So this is generally income that doesn't have any costs associated with it either. So I sort of call these free kicks. So coming back up to here, when we do issue this template, we'll just include 1 line that has a bit of data in there. But the way this works is that in this first section here, these are the existing jobs that you have on the go right now. So I would take a bit of time to sort of populate this client name. You can get this from, well, hopefully you'll have a bit of software behind you to grab this from immediately. So whether you use Build Xact or Build a Trend, I mean, Build Xact is our preferred platform as well. You should be able to get a lot of this data straight from those systems and go, well, this is when we started. These are the GPs these projects should be running at. So this is a markup, this is gross profit. So for this one here, 123 Fake Street, 20% GP. This is the contract price ex GST. So whenever I talk to clients, it's always excluding GST because you don't get to keep the GST, that goes to the government. So it doesn't matter whether you collect it. So you send an invoice to a client, they pay you it, and you collect the GST, or whether you're paying it through creditors, it's always ex GST. So this contract price here is 404,000. Now we're doing a budget from 1 July through to the end of the financial year. So we go, well, what have we billed to the 30th of June, or what am I planning to bill? Well, I build out 80,852 in this example. So one minus the other is, well, I need to forecast out where I think the rest of the money is going to land. So we've got 323,000 to bill out. And then what you do here, I mean, every builder is different. I mean, I haven't sort of seen 2 builders of the same thing, to be honest. You need to forecast out your claims as to when you think they'll land by month. So ignore WIP and all the rest of it. This should just be per your claim schedule or a forecasting line in the background or a cash sheet or whatever it happens to be. But you should be able to map out this based on some sort of scheduled timeline as to when this income will land over here. Now, the numbers in here are a little bit rough, and we have got some, I guess, like a bit of a hidden column here just to work out as well. So this one here, for example, 323,000. We've only built 212, so there's likely going to be a little bit of overlap into next financial year. So there are a couple of little cheat columns to help you work, I guess, to work with here. And this is just current projects. So once you do map these out, it's easy to reforecast off this as well. So it's worth the effort to get these in. You can add more columns in here too. We might release a version that has a few more columns in there, but you can collapse this if you haven't got many in there, so keep it a bit tighter. So push the claims out. Make sure you drop the gross profit in here as well. Really important for the calculation of COGS in the background. So that's revenue for existing projects. Coming on down to new projects, there's a few different ways to do this, and I've got a builder at the moment. He loves reforecasting monthly, actually, which is great. You know, I love the forecasting process. How much money we're going to make? What happens if we fold in this project? What happens if we fold in two? What does that do? How does the profit work? So generally, what you sort of start with here is you start with projects that you might have like sort of freshly signed, but haven't sort of landed on a build date yet, and exactly the same process. What's the margin? What's the revenue? There's obviously no billings in prior period. So then you just have to forecast this out. And it can go over the year. You know, some of these builds go for 2-3 years, especially in a sort of higher end architecturally designed space, 3.5 mil plus. Map them out as best you can based on when the stages are going to land in here as well. So whether it's percentage completion or whatever it happens to be, drop those in where you can too. And then just list them out. So obviously call them something unique, you know, Flinders Lane, whatever it happens to be, just so you know what you're looking at. Map these out, and you can adjust the GPs in here as well, whatever it happens to be. So this guy here, or builder, is in the renovation space. So these GPs here, rubbish. You know, if you're sort of pushing that sort of 22 to 25 space, you know, high to the 25s. Yeah, and you are in that reno space, sort of sub 2 mil, 2.5 mil. I mean, they're the GPs you should be chasing. Just a bit of a free kick for those on the call. So you've gone through this, applied heaps of science behind it. Don't just chuck in flat $100,000 over here, or, you know, make sure you do apply a bit of science behind it, because then this will have a bit more value, especially when you go to measure yourself against it. Take the time and effort to sort of push this through and go, right, well, this is what all my income's doing. And then we can go down the bottom. Well, we can sort of see between new projects and old projects what our revenue is doing down the bottom. Now, on this side, and this was pretty important, you shouldn't have to amend anything over here, because if you have your GP rates correct, this here will actually back calculate the costs that are involved with these projects. So keep in mind, this isn't like an actual tool. So it doesn't measure overruns and underruns and provisional sums. This is just the plan at this stage. So if you have revenue in there, so say you got a contract for $1 million and you got additional allowances in there of $100,000 for provisional sums, I'll probably leave the PS stuff out. I mean, unless you sort of have like a cost base in there, and then you can adjust as the forecast rolls through, you can readjust these numbers so they come through as well. So from the cost side, as long as you got that GP percent correct, there should be no updating over here. Everything should update. You know, there's formulas and stuff all over the place in there. It should update here, and it will hammer out how your business is looking down to this gross profit line here as well. So 230 in July, August, you know, so this is revenue, 271. It bounces around a little bit. A few more contracts come on board. Here is the cost of goods. So this is really like, this is a bit of a broad brush approach. Like, you notice there's nothing in there for wages or individual creditor payments. You know, that's more cash flow forecasting. This here is your budget and go, well, if you've built your quote out correctly, so you have this quote, it goes on forever and ever and ever, and you've got right materials and sub trays, you've got the correct carpentry labor, and then all the rest as well. You go, well, if we stick to that plan, you know, some beautiful numbers should pop out of the bottom, assuming your margins are strong enough as well. And then obviously revenue minus costs gives the GP. So this is all calculated out. So we try and keep this front sheet needing little data entry as possible. I mean, when you are on this, you obviously can drop in your own company name and your own logo, you know, make it feel personal, you know, give it a bit of personal touch, you know, be proud of this. You know, hey guys, we work hard, or family, you know, if we grind through this, you know, this is what we'll make at the end of the year, which is pretty exciting. And then if you give your tax accountant this, they'll love you for it, especially on the tax planning side. I mean, keep in mind the tax guys love historics and how much money you're going to make and what do we do with the tax. I mean, in my world, clients, when they sort of complain to me, oh, I've got too much tax, I'm like, well, that's good, because obviously you made a bucket load of money. And you made a bucket load of money, you have to pay a bucket load of tax, but that's when the tax guys tag it and go, well, how do we minimize this? with other strategies. So that's a byproduct of obviously doing pretty well here. So revenue side, really important. So build this out, build in 2 sections, apply a lot of love and care into this too. You can get into like a bit of a reforecast. So say you get to September and claims happen, or say there's a huge wet weather event or something, you can just adjust these around. Just make sure that obviously any revenue that doesn't go over the total amount over the side here. And then with the new projects too, I mean, you might want to sort of get into this quarterly and add new projects in there. And then obviously if you sort of come into October, you might have lost a project, so delete that out, drop in another one and go, right, if we drop this in, does it work? And then at the end of it too, I mean, you might drop all these numbers in and go, look, have I got the right crew? Do I need another team? Do I need another laborer? You know, apply a bit of science behind this, because step 1 is obviously crunching this out. You know, step 2 is trying to rationalize this and go, look, can we achieve it? And step 3 is going, oh, what else do we need to do to try and hit our targets? Or if we have a bit of a hockey stick at the end of the year because revenue's through the roof, what other actions do we need to take now to make sure we get these numbers? So that's income and cost of goods at a pretty high level. And I'll circle back around to this one in a second, but revenue's filled out, claims are filled out, new jobs are sort of filled in here as well. You can drop in signed contracts only, or you might want to drop in stuff that's pretty hot too. So you do like a bit of a scenario analysis. You know, if this comes in, if that comes out, what does that do? So you can list these projects there, drop in whatever the contract's worth, cash flow it out, or I guess claim it out, and see what happens to your overall bottom line. And it's all live, guys, so everything links back to the front sheet. Just make sure you pick up the revenue and GP for those. If you're in the building space, don't put anything less than 20% team, unless you're in the project home space. It has to start with the 2. Again, just another free kick there. And it's gross profit, not markup. So if you prefer markup, 20% GP, it's a 25% markup for the project. Coming on down to admin expenses, and I know a lot of builders love to play with this and spend a lot of time in there. So I've actually sort of built a bit of a different section where you can go a little bit deep if you want. So there's 2 tabs in here, well, I guess 3 tabs here, which feed into this. One is this section here. So when you build out your chart of accounts first, and I'll be a little bit of an instruction sheet in here, you can add additional accounts in here. So for example, you can have like an example P&L account. If you do need more or less, this is just in here for demonstration purposes. It will update to the front sheet back here, and it will automatically populate it in as well. So what you could probably do for this section, almost exactly the same format, months across the top, here's your income across the top, and then these are all the expenses. You should be able to just grab, I guess, go into Xero, grab your P&L overheads, and almost just sort of just drop that in directly into the spreadsheet, just to sort of save yourself a bit of time rather than trying to hand type it out. So jump into your P&L, export it, copy and paste this in, and away you go. And you can add more rows or less, but if you have more than sort of 30 in there, like it's a waste of time. I cut it out and just creates bookkeeping noise. So this here is the summary sheet of the data that sort of comes in from this admin invoice detail section. It is all month by month, mapped out, planned out. I've just taken a bit of a generic approach here as well. You come on down to the bottom. Here's the operating expenses. Overhead wages are on a separate tab, which I'll get to in a second. But ultimately, at the end of the day, here's the total overhead costs in the business. Where we want to get to is we want this number here to be 10% or less, and it will go up and down based on stages. But if you get to the end of the year and the law of averages iron out, this build is actually running a little bit heavy. So it's not devastating, but we either need to lower overheads, or the way to fix that number the other way is to jam in more sales, because the overhead base is too big for what this builder needs currently. And then down the bottom here is just a bit of a visual representation as to what goes on. So that red dotted line is what you should be chasing. Anything that goes above that, you need to have a bit of a look at it, especially if you land at 12% at the end of the year as well. So, I mean, I'm a bit of a visual person. I mean, I like the numbers, but if I can look at this graph and go, oh yeah, we've got a problem here in September and October, we go in and go, well, our overheads haven't moved all that much in the background. So what's our issue? Oh, hang on, we've got a bit of a revenue dip between here. And you can go away and go, well, do these numbers make sense? Yes or no? Well, we've got a revenue problem because overheads don't move all that much. Can we bring any of these claims forwards, or any of these claims forwards? Can we work harder? Can we get another gang on board? Because that's obviously going to bring those claims forward as well. So This is the second half. We'll go, well, look, I've hammered in all these numbers. Does it make sense? And does it pass the sniff test? The short answer is no. If this client was sitting in front of me, we need to work out how we sort of squeeze that down. So where do all these numbers come from? If you come into this admin invoices section, and I'm hitting you with a lot of numbers now, so just bear with me here. This here is just straight from your P&L, I guess your ledger for overheads. You can just copy and paste those in. Everything updates here in the background as well. Like there's a few hidden cells and columns and formulas and stuff, but each of these columns, so each of these rows here are the subheadings for the ledger that you had on the other page, or I guess a P&L extract that you had on the other page. So accounting fees, for example, however you do this, I mean, you might just get it at the end of the year, or you might, if you're with us, you obviously we're a fixed fee firm, generally, especially for the tax work, we'll have some sort of fee base in here. So you might have CFO Advisory in there as well, which is what we do. You know, it might be, I don't know, $1,500 a month. And you can sort of see quickly that updates all across there, and you can build these out individually for those that like the detail of building these out. So rather than just going a flat fee, you start to see we start to hammer out individual accounts. You know, it could be subscription fees or advertising, hammer these out here, and generally everything updates over to the side. With this too, I'd probably be, you're welcome to be a bit confident with the numbers over here. Like, don't be scared of formulas and all the rest of it. So like, for example, with your accounting fees, if you only get charged at the end of the year, just jump in, zero that out, and just go, oh, look, I just get a $10,000 bill at the end of the year. So don't be afraid to jump and have a bit of a play. Just do it in the white cells. Don't do it in the light blues. So I'll just take that one back out. And then just run top to bottom. So whatever is listed in here, it will be sort of categorized in these rows here. There's a big formula that underpinned it. And then just spend a little bit of time in here going, well, looking at what are our monthly costs? Because you'd be pretty surprised that when you do this for the first time, you itemize everything out, you know, all those sort of like $10 and $50 direct debits out of your bank account, you might sort of find that there are recurring direct debits you just don't need anymore. You might have upgraded, you know, you might have gone from a time and attendance system, an old one, to a new one like Deputy, and the old one's still coming out. I mean, it's important, even though I sort of say don't spend much time in this, it is important to sort of review it probably every 6 months, just to make sure you're not losing money. I mean, because every dollar counts, obviously. So I would work through this top to bottom. You've agreed on how your ledger looks. You then enter these out sort of line by line in the background, because once you do it, you shouldn't have to look at it again for a while. And just spend a bit of time in here as well. I mean, because you don't want to sort of just slap numbers in and you got to measure yourself against this, and then it just doesn't hold any value anymore. I mean, you want the budget to be rock solid. So when you do pull out the measuring stick and measure yourself against it, you want to go, oh, look, that's where I've sort of come short. Or conversely, you know, hey, I managed to pull this claim forward by 2 weeks. You know, the carpenter's on site hustled. I found another great chippy. You know, he's a unicorn, and yeah, now I'm making some really decent money. So do spend a bit of time in here. Don't be afraid of the spreadsheet. Have a play. You know, save it frequently, or save down version 2s and version 3. So if you do muck anything up, you can easily sort of fire it up from an older version as well. So just enter what it is. You might have, I don't know, CBA fees in the background, and, you know, on average, you know, it might cost you $80. Honestly, I guess it's just a couple of other little tips of this too is, you know, if you're trying to run through bank statements and trying to calculate $20 of interest and $50 of interest, and you're spending 15 minutes to get an $80 a month transaction line, especially with the amount of money that comes in the top line, like, just don't burn the time. I'd rather you spend almost twice as long here trying to figure out how to bring claims forward, because obviously if you bring these claims forward, it doesn't change the percentage, but it changes the dollars that pops out of the bottom. And there's a whole separate piece on job profitability that we've done in a separate webinar as well. But I'd almost spend your entire time here sitting with your construction manager, project manager, estimator, whoever sort of leads these projects, site supervisor, and go, how do we bring these forward? Can we execute this? Can we deliver on this? Because at the end of the day, I mean, in this instance here, that's the money you want to try and chase for this builder at least. So admin expenses, just work top to bottom, left to right. Don't be scared of the spreadsheet. Have a crack at it. And then just down the very bottom of this one, apologies, as long as you're sort of sitting at 10% or below, that's fine. If you're sitting over, yeah, it's not a huge issue, but you definitely need to have a look at it, or, you know, speak to someone internally about it, or reach out to your accountant or someone like me and go, look, what are the strategies to try and pull that below 10%? The final piece when you come over to here, so when you fill out these two tabs, it fills out everything down to here, which is just straight from your ledger, I guess, and everything sort of flows through, drops in. But then down the bottom here, obviously you have your overhead and wage costs in the background as well. And you have two types of wage costs. One is in your overhead section and the other section is up in COGS. Now, just a reminder, when we've done the revenue side, the cost side sort of falls out. So this isn't a cash flow. So if you turn around and go, hey, Dan, you haven't got timings in here for creditors and all the rest of it. This isn't a cash tool. This is an accrual tool. And as long as you've got your GPs right and you've got your project manager costs in there and chippy costs in there, all these formulas, all the rest of it should work, which gives this number down the very bottom, I guess, a bit of evidence, science behind it. So your next biggest cost in the business in the overhead section is salaries and wages for your back office team. So that could be admin, or you might have an estimator out there that you don't put recoveries on, or your bookkeeper, admin person, whoever it happens to be. So it's important to build this out as well. So there's a whole tab over here, which is just for the salaries and wage people. Now, ultimately, at the end of the day, it's just the overheads that we're trying to capture here. But a lot of people like just to build out their COGS employees, or I guess direct costs like your tradies and stuff, your chippies that are on your books. You can drop these in here as well. It doesn't do anything to the overall calculation, but it's good as like a bit of a one-stop tool to go, hey, what's everyone getting paid? What are they doing? Etc. So here are just some rough names I've pulled out. Again, just work left to right on this too. So, Daniel Wilkinson, he's a cog. You can sort of select him here. And this is important because this is a driver for the front sheet. So if I select him as a overhead, it will increase that overhead amount on that front budget P&L. So he's a senior tradesman. John Jones here as well. He's a director. He's a 50% overhead. So you can put in like little cheat comments in here as well and go, well, 50% of his time is recoverable. So half of his time sort of sits up in wages above the gross profit line. And so he might be on the tools, or he might be sort of doing sales or whatever it happens to be, estimating, however you guys do it. But yeah, 50% of his time is non-recoverable. So that's why we've taken a bit of a haircut on his wage. So you just work through this, just be a bit careful of formulas and stuff on the top. But if you sort of list out the people here, what they do, what's their salaries, the rest of the sheet should work it out itself. The only thing just to be a little bit careful of here, because wages are pretty lumpy. I mean, sometimes you might have 5 payrolls in a month or 4 payrolls in a month. Just make sure you just drop in the number of payrolls that are in here each month as well. And just be a bit careful of that one too. So for example, if you pay people on a Tuesday, if you come into June here, we've got 1, 2, 3, 4 Tuesdays. Or July, for example, you've got 1, 2, 3, 4 Tuesdays. So it's a 4 pay period entry here. And just be a bit careful of that because it does push these numbers around pretty materially too. So all this is self-calculated. The only cells you need to sort of focus on here is just the number of payrolls in each week. Come across the side here, just enter these in here, and then obviously what their wages, and the spreadsheet should do the rest, and it will pick up the overheads directly. So just be a bit careful of how you tag it there, and that will feed into this section over here as well for wages. It also self-calculates superannuation as well. Just the final piece to talk about here is you can preload in your superannuation work cover rates. So next financial year is obviously running at 11%. If you contribute more or less super, well, obviously you can't contribute less super, but if you are paying people overtime, obviously there's no super on that. I'll probably just leave it at 11%. I mean, it's 2/5 of not much of the overall wage cost in the business. I'll just keep it simple and go, yep, let's go straight 11%. And then with your work cover rate, just make sure you know what your work cover premium is, whether it's 2%, 5%, 6%. If you had the 6% mark, obviously you've had a few claims in there as well, because all this here will really impact your budget. And if you have, like, for example, high work cover claims or high admin overheads, this number here is going to be a nightmare. Could be 12s, 13s, 15s. So I had to build it recently. It's probably close to about the 20% mark. And yeah, obviously, and again, we obviously put that in the microscope pretty quickly. There's a construction manager who wasn't doing too much, well overpaid for the gig. the owner was actually doing most of the high pressure roles. So we've actually sort of swapped him out and swapped in someone who's a lot more junior, but I guess more process orientated. So the budget here tells a bit of a story as to what you need to do, and I guess how you need to sort of change your business, whether it's lowering overheads or increasing revenue or increasing margin. What does that do to the overall picture? So I've pushed through a bit of content there pretty quickly, and hopefully everyone's pretty comfortable with it. But what's happening here is we have income at the top, super important, which comes off this tab here. Build out your projects, build out your claims. I'm a massive fan of multiple people on the tackle. So what I mean by that is bring your supervisor along, whoever it is, and go, hey, these are our milestones and schedules. Does that make sense? If you're a bit uncomfortable with open book, don't show open book. Just show them this tab here and go, look, do these claims work? Whatever your process is. Make sure your GPs are accurate. GP, so gross profit, not markup. If you need a bit of help with that, reach out to me. I'm happy to send you a calculator. New projects that can be signed close to finish. Look, it's really up to you. I mean, each of you will have your own process for managing your own sales funnel. And as I go through the snake, drop in stuff. You can use this as a bit of a blue sky tool. Drop them in and see what it does to your overall number. Like it's pretty exciting to work with. You go, hey, if I win this project, this should give me an extra dollars at the bottom line. Admin expenses. This is the summary. Make sure you just update this with your current ledger. If you have more than 30 in there, cull it or make them inactive. Too much noise. These are all formulas that are driven off this sheet here. So there's accounting. Back here is accounting. And if you get multiple charges, whatever it is, or bookkeeping, whatever it is, just build these out here. So you can do like a flat fee in there and it pops across to the right. That all feeds up into this. And you want to make sure that this blue line stays below the red, or if you're going through a bit of a growth phase, that this end number is below the 10% mark as well. And then salaries and wages, just work left to right. Here are the people. Make sure you're really careful around this allocation because they'll change the front. Drop in the wages and the spreadsheet will do the rest. And then just update these two down the bottom as well. And then coming back to here, does it all make sense? Builders, if that number there is not a 10% or better, yeah, or if it's less than 10%, apologies, yeah, you need to give this some pretty serious thought. Otherwise, I think that's about it from my side.
Awesome, Dan. So I'm just interested. I mean, obviously, we're looking at a sheet here for a builder who's obviously, done all the work in terms of updating the tool, getting the visibility in place, and numbers look not too bad for this scenario. I wonder, is it worth just having a look at, when you were talking about why budget, you were talking about being able to see the bus coming down the road, being able to see issues that might be ahead. Can you maybe, it might be worth just having a look at updating the sheet now to reflect what that sort of scenario might look like. So maybe there's not a whole lot of jobs in the forward plan, or there's some gaps in terms of when those jobs are going to hit. Just as a way of just demonstrating how the tool works in that kind of a real world situation.
Yeah, good idea. I mean, I sort of alluded to that before, is that when you sort of put the effort in and, a lot of science and effort doesn't make sense, you can sort of flip this around on its head and start to do what I call sensitivity analysis. So, for example, one really quick idea behind this is existing projects are generally pretty easy to map out. You can sort of get that to the end of the year. But you might find with these new projects here, you might only want to drop in projects that have a really high probability of winning. In which case you might go, hey, these projects here are actually sort of short and sharp, and I have a pretty decent revenue hole here in the background. These are going to be done within sort of like 9 months for this rentability here. I actually have a big hole in the background there just because I don't want to put anything in there. I'm a bit nervous. This other job's been a bit flaky, and you just want to add extra lines in there. And you go, well, let's come back to this front sheet. Does the rest of the sheet make sense? So you can sort of go, here's a trading income. It definitely tapers off around April, May, June. You fast forward down to the bottom line and you go, oh my God, like look at these reds, look at those percentages. And then you go, well, that's good, Dan. What do I do with that information? This is what you sort of, I guess, what you start to call a bit of a bottom-up budget, going, well, here's a hole. If I dropped in a project, and you can have a one-liner, and again, this is a bit of blue sky thinking now, and I go, well, if I could win something at, that sort of spits out, I don't know, $200,000 in claims, and that could be over one or two projects. So this is your blue sky project now, or, sales target. So we'll call this sales target, either for yourself or your salesperson, and go, well, if we sort of punch out $200,000 in claims each month, does that get us back out of the danger zone? Well, the answer is yes, absolutely. So you can build this back the other way and go, well, these projects up here are known. You know what they are, they know the claims. These ones here you might only feel comfortable with if they're red hot, like 90% probability of landing, or you have wet ink on your contract. And then this one here, you go, look, Dan, I'm just not confident in my sales funnel. Where you can go, well, in Q4 here, without this, it's actually a bit of an issue. Red, rubbish, bad, etc. But if I win these contracts here, 180 or 170s, whatever it happens to be, there's a bit of blue sky on here now. And if you're sitting in front of me, or you or me are building a budget, I'm like, well, Phil, you're from Century Builders. You need to go find 780 grand worth of revenue to make this budget work, and to ensure you sort of hit that sort of 10 to 15% at the bottom line. So play with it. Don't be afraid of it.
That's where you're sort of saying that it's one part scorecard, because you're tracking your existing jobs and how you're performing against the budget, but then you're also be able to see one part game plan, one part scorecard. So by using this tool as a scenario planning tool, you can see, I can see now here's going to be a drop off at the end of the year, and I can start to model in sales targets around it.
Yeah, absolutely. And I guess that's the feedback loop as well. You've done this work, done this effort. What's the story that it tells? Have I got any holes? And then what do I do to plan to sort of backfill it? What's the story that the numbers tell me? And that's the important piece. If you put together this budget, you can't tell the story from it, you probably need to start again or go back a couple of versions and recut it until you do.
Yeah. And then, you're talking about effort. I probably have a few people on the call at the moment looking at this going, holy shit, this is a lot of work ahead of me here. I'm assuming that there's a fair bit of investment of time and energy up front to build it out, and then it gets easier to update from there. Like it's the bulge going through the snake in terms of the original investment of time and energy, but then updating from then on. You've already committed, you've got all that data in place. Reframing and reforecasting is a bit easier from then on. Is that the case?
Yeah, it's a good question, Phil. I mean, usually when you sort of do any of these things for the first time, a lot of the people on the call will be good at swinging the hammer and building houses. They won't have an affinity with spreadsheets, but you sort of get out what you put into it as well. What's your target? What are you chasing? So there's a little bit of effort to set up first, but once it's set up, to maintain it going forwards is pretty quickly. Like I mentioned before, I've got a builder who loves doing this monthly, so we sit together, pop over Builder Trend. He uses Builder Trend, dust it off, quickly push claims around. What does that do as a business save? Oh no, we've actually reforecast here. You got a problem in February because we moved these claims around and this project didn't work. As you saw, I could drop this stuff out pretty quickly. And this isn't too far off our master model that we use as well. You can start to sort of go, well, is the future safe and is the future locked down? As to how often you do it, I'd probably recommend doing it quarterly. But look, if you sort of love knowing where you're going, love financial clarity, how much money you're going to make, it's probably worth doing it monthly, to be honest.
Yeah.
And look, it doesn't take too long.
The majority of our clients will do it monthly. I know you're sort of sitting down monthly, going through management packs, and a budget is the major feature of that. But from what I'm hearing there, at least doing it quarterly allows you to see enough, far enough ahead with accurate enough information in front of you to make some better decisions. And is this, in terms of the practicalities of updating the budget, is that a lonesome job for a builder at 10 o'clock at night when he really should be spending time with the family, or is it a team sport? how do you see it working practically from a day-to-day existence point of view?
Yeah, another good question, Phil. I mean, if you're sort of, I guess, a little bit smaller, you might be turning over sort of 2 or 3, and again, you're wearing probably 15 to 20 hats. You might have to have a bit of a crack at it yourself, get it set up, and then you can sort of tag it in the better half or bookkeeper to update it, especially on the claim side. But if you have sort of robust systems and processes in place, say you preloaded claims into Build Xact or Build a Trend, you got the dates and the amounts and the percentages, you can actually sort of systemize that and go, well, look, well, I've already sort of forecasted the claims in. It's in Build a Trend or Build Xact, and you can push that process down to a bookkeeper or better half or admin or super, whoever it is, and go, whatever's in there, I want you to update it, because the builder might be updating the master claim sheet, I guess, in the software ideally, and the bookkeeper's a process, go, hey, add this to your monthly list. I want to buy workday 3 after end of month, update the claims that I have in there and push this out to me. So I'm a big fan of multiple people on the tackle. The more people I have in there, the more brains, different people thinking about different angles. So if you can sort of pull in a couple of key people into, I think it makes sense. But if you're getting home at sort of 6 o'clock, 7 o'clock at night, dinner with the family, dust off the laptop, and oh my God, here we go with budgets and forecasts. Yeah, you're probably doing yourself a bit of a disservice, to be honest.
And then you talked about open book versus not open book, or including some of your team in the process. Where do you think that really cuts in? Like, if we had people on the call running their own business who are a bit concerned about sharing financial data with team members, what's a sort of minimum that you think is worthwhile dialing people in on?
Where most businesses will make money will be around the gross profit and, I guess, execution of projects. So in saying that, I mean, sort of drive accountability, outcomes, on target, off target, whatever it happens to be. I mean, you have to open the books to an extent. I mean, I probably wouldn't share bottom line numbers. I mean, unless you've got some pretty serious trusted advisors or other equity partners in there, but absolutely down to the GP line as well, especially if you're folding in really strong accounting processes like job costing, WIP, down to the cent, your unders and overs. So what I mean by that is, you might have 10 grand for a retaining wall quoted for it in this huge quote. It comes in at 12. Well, I don't care about the 10. What I care about is the 2 that you've cooked. So now you're no longer making 100 grand off this project. You're now making 98, and you're only sort of, 2 months into this 18-month project. That's the number I want to know. Have that bit of a microscope about what's going on. So, I mean, if you want to staple accountability and responsibility to someone, which if you're growing and slotting heads under you, you have to give them some sort of KPIs or targets, or at least open the books a little bit and go, hey, this is actually financially how we're going. I guess where you draw the accountability lines from that. So yeah, to an extent, down to the GP line for your key people, especially the people that are doing the estimating and quoting. Definitely. Or the people that have to deliver on it, really important.
Yeah, I guess you get 2 bites of the cherry there. You're engaging them in the process so that they, can see the actual outcome of the business and be attached to that at a financial level. But you're also improving the quality of the data and information flow in the business too. And you get a higher degree of accuracy around, when things are going to fall and how jobs are traveling and the like.
Yeah, absolutely.
Just one more. I mean, I just want to pick up on that point around adding in, updating the budget and this kind of, financial hygiene, adding it on to other processes in the business that other team members are already, on top of and responsible for. Because I assume that, if you're using something like Build Xact, that allows you to see, margins, you're able to see where jobs are progressing, where they're up to. And so you might have a bookkeeper who's updating Xero or Build Xact, that then, you could just have this as part of that workflow, yeah?
Yeah, absolutely. I mean, especially if you put the effort and energy into the budget to build it, it's backed by data and evidence, and the claims make sense, and sort of blue sky. You can tuck in that, I call it, I guess, like an actual best budget process. You get to the end of the month, you're pushing your WIP, your accrual accounting, costs are in the right place, in the right buckets, and go, well, look, the budget says we should have made 30 this month. We only came in at 20. What the hell happened? And generally, as long as you sort of tell the story between the two, that's the important bit. So you might have had most projects landing on time, but you might have got concrete or Rio for a driveway or something wildly out. Oh, geez, how, what's our learning from that? Okay, we've got another project on the go. Our estimating spreadsheet's broken. We need to fix that up. Because the philosophy behind it is that if you measure yourself against this budget, you want to see the bus coming and, ideally sidestep or take the learning from it and apply to the next job. If you're not doing, I guess, strong budgeting, strong management accounting, WIP, all the rest of it, I mean, the bus is probably, driven over you 5, 6, 7 times before you get to the end of the project, grab all your costs, stick them in one bucket and zero and go, Jesus, I hope we came to 500, but it's landed at 750. It's too late by then. How do you act on that? The bus to run over you.
Yeah. I might just, so we're going to open up for questions just in a second, but I might just, before we do that, I just wanted to share, so essentially Dan's more than happy to do a session with anyone. You can see that all right, Dan?
Yeah, it's come up, mate. Thank you.
As part of us engaging with new clients, Dan will often do, just an initial for half an hour to an hour of consultation. If you want to scan that QR code, Dan or one of the team, it actually goes through to a booking system, so you can just book a time in the calendar. So we'd be more than happy to talk through any of the things you want to chat more one-to-one on before we go to questions. If you missed this QR code now, don't worry, we're going to send it out on the video and a link in the email. And we'll also be sending out a copy of the budgeting tool that Dan's put together. And we've had some questions on some of the other tools that Dan's referenced as well. So I just thought I'd show that so that we could, you can book a time with Dan if you want to. So Dan, over to question time. Now, I'm happy for people to use either the Q&A function, or you can, if you want to, you can just drop it into the chat. Either way, don't mind. But there was a question there around having buffer in our budget. So should you be building buffer in, Dan, or should it be a really tight budget? What's the go there?
Yeah, look, it's a good question. Look, and I have a lot of these questions, I guess, these conversations with builders when they're trying to build out an estimate. Dan, do I build out an estimate, then add 10% contingency and fat and overrun, and then apply my margin? My view is that I'd rather have it sort of running pretty tight to plan, because if you're adding contingency all over the place, it starts to lose a bit of detail. So say, for example, accounting fees is probably a bad example, but use it anyway. You say, oh, look, I'm going to chuck in 15 grand of accounting fees in there. It's going to be heavy. It rolls in a 10. And then as you sort of get 4 or 5 months in, you might get monthly direct debits. It should be sitting at $1,000 or 1,200, but it's only coming in 1,000. You go, oh, what do I do with that again? Do I pull this out? And I'd rather it run pretty accurate. And then if you want to add a contingency and stuff in there, or, you might want to have a pot that, there could be 10 grand for R&M or innovation or subscriptions you haven't taken up, or, new computer rollouts, whatever it happens to be. But those individual lines, I'd rather them run pretty tight, because then you can tell the story. Hey, subscription should have only cost us $500 a month, but came in at $550. What's going on there? Whereas if you're building a contingency at $50 or $100, you can't really tell the story anymore. And you go, okay, well, that's the number. Because the purpose of the budget is that you want it to be sort of really tight and really solid. You need to be able to tell the story, especially 6 months later on, and go, oh, you're on track. And then if not, why not? You can't do that if you sort of build in buffers and stuff all over the place. So you want it to run pretty lean.
Yeah. I mean, I guess it's the more accurate, the better, right? And then if you want to, you can use that scenario planning that we talked about before. If you want to look at, various tolerances and the like, this budget running out, this job running hotter than I thought it would, or, any kind of scenarios that you might want to throw in. So question here, what was the figure that should be under 10%? Was it GP over total revenue? What was that called? There's a few 10% in there, really, isn't there?
There is. So a good P&L looks like, guys, so there's revenue, direct costs. Revenue minus direct costs is your gross profit. If you're in the building space, and I'm generalizing here a little bit, your GP needs to start with a 2. You take out your overheads. So your overheads will spit out a number. So that number divided by revenue. So if your accountant talks to you, or anyone says, oh, what's your overhead percent or GP percent? Just think it's whatever that line is divided by revenue. So your bottom line after you paid everything, everyone yourself, needs to be 10%. So for every dollar that comes in, COGS takes a bite, overheads takes a bite of that dollar, 10 cents should land at the bottom, or 10%. So there's heaps of words for it. There's net profit, EBIT. So EBIT is like earnings before income tax. Yeah, so I mean, look, it's just bottom line profit, or I guess net profit before tax.
Yeah.
Super important.
So there's another one here. So Melinda's a sub-trade and deal with retention. How would you treat that in a budget?
Yeah, really, really, really good question, Melinda. And that was sort of that piece I alluded to at the start when you go, I guess, budget versus cash, or I guess actual versus cash. So keep in mind retentions, I guess retentions are a contingency in case something goes bad on a contract. So whether you're the income side, either collecting income or withholding it from sub-trades, it is pretty important to recognize that. So what I mean by that is you might have a $100,000 invoice, 5% gets withheld from a retention, and obviously 2.5 practical completion, and 2.5 obviously 12 months time. But it's important to recognize that 100 grand is income, not the 95, because you've worked it, sweated it out. It is your income. It's just the time of your cash that you have to wait for. And that's a really important philosophy. And we're sort of getting into balance sheet territory around that, because there's a whole separate piece around balance sheets. But if you have $100,000, I guess, in a claim that you have to push out, I'd recognize $100,000, and then $5,000 sits in the balance sheet as a retention or cash, because you're entitled to the revenue. You've already gained the profit. You just haven't received the cash for it yet. So there's two very different pieces. But short answer, I'd recognize 100, not the 95.
Yeah. Another one here on the way that the margins are dropping in as a major determinant or major pull through in this, and wanting to know what happens if there's a question mark over the accuracy of the margins. I don't think they've got a handle on whether their margins are correct or not.
Yeah, I mean, the budget process assumes that you know how to build a quote, you know how to estimate works. The estimate's rock solid, and we can do probably a separate section on this one as some way today. We're starting to get some pretty decent material on the website now. But I mean, if you're sort of pushing out quotes and you don't know what that GP is, and again, not trying to generate fear or anxiety, I mean, that's amber alert territory for me, sort of coming into red alert. I mean, you have to sort of know how the quote comes together, how it's built up, what's in, what's out. Have you got some of your time in there personally as a builder? Yeah, you have to know that. Otherwise, when you drop in that percentage in there, it's not going to mean anything. Because if you're doing a few of these ones, yeah, it's going to hold less water. It's going to be less relevant, and you won't look at it and go, oh, that can't be right. And yeah, it's a bit of a downward spiral from there. Yeah,
so it sounds like it's the first order of business is make sure that you've got accuracy in terms of the way your margins are operating.
Yeah, and how your estimate comes together, and how you do your markups and provisional sums and all that sort of other side as well. Yeah, super important.
Yeah. All right, any other questions out there? I just we'll do a final call before we wrap up, because we're just hitting up on a time limit here. So
yeah, there's one more, I think. There was a little section on there. I missed a part. Yes, I was Test Mobile. Hello.
Yeah.
I missed a part in regards to super. Yeah, look, I mean, it sort of comes down to award, and we're sort of deviating out the budget side. But essentially, the way super works is it should be paid on ordinary time earnings only. So if you'll have to go back to the award and just double check this anyway. But I mean, I've done labor hire for a while across a lot of awards. But if it's classed as ordinary time earnings, so like normal wage or where it happens to be the super on it, generally anything classed as overtime, there's no super payable, because they're getting 1.5, 2 times rate. But yes, super is generally not accrued on that if it's classed as overtime.
Yeah, but again, check the awards, because allowances and the like, vary quite a lot across the board, industry to industry. Any other questions before we want to take off? No, I think we're good. All right. Well, thanks again for joining us today. We'll be sending out a copy of the webinar with the tool that Dan's just taken everyone through. We'll have some links to some of the other content that we've done previously, things like our WIP calculator. Always a lot of questions on how to calculate WIP, and it's a really critical part of the financial mix as well. So we'll send that out in the next day or so. But yeah, if you like these webinars, we do one of these pretty much every month now. So please, if there's a topic that you're interested in, you want us to dive into in some more detail, then hit us back on our email. But apart from that, we look forward to seeing you again soon. And yeah, reach out if you want to have a chat about anything we've covered today, or to book a time with Dan. All the best, and we'll see you around.
Yeah, thanks everyone. Thanks, Phil.
Bye.
Bye.